Hi, everybody. I'm Scott Callan, Chairman of Ichigo. I'm joined by Dan Morisaku, who is a senior member of finance team and our head of global IR. I'll be working off of a presentation that's on our website, FY22, so the February 2022 Q1 corporate presentation. Somebody gonna put that on the screen for me? Answer is yes. All right, let's get going. Let's jump forward. This is our first time doing a Zoom meeting. Hopefully, it's going to go well. All right, let's start on page 8. FY 2022 Q1 summary. It actually was a pretty light quarter from an earnings perspective. With actually, from a business perspective, a very good quarter. We think Q2 will be a little light also. But there's clearly a major change in the market environment. It's going to be, we think, very productive for us from an earnings perspective, and you'll see the results primarily in the second half of this year. We'll continue to have a very slow hotel earnings recovery because of COVID. We are running at 30% of revenues, so down 70% relative to pre-COVID. In the quarter, we did primarily 2 logistics asset sales. The value add was completed. Gross profit margin on them 34%. There has been no COVID impact on clean energy, which continues to grow very well. So stock earnings in that business. So those are our fixed earnings, up 18% year on year. We launched 2 new businesses. Well, in effect, one new business, which is Ichigo Owners. It's a GP/LP structure. Co-ownership business, so it's an asset management business. I'll go into details on that later. And Prepara, which is our AI-based hotel revenue management system. In fact, the launch of that business is we began a full-scale rollout of that with external sales promotion to clients. And I'll go into some details on that later. The final thing we did is we accelerated our RE100 target by 15 years from 2040 to 2025. Turning to page 9. This is again a slide here. Those of you who have been with us before, and many of you have, so I thank you for that. It's familiar. It's a durable earnings model. We continue to run at earnings despite a very depressed earnings environment due to COVID at double our fixed expenses. You can see we're down year on year on our stock earnings in sustainable real estate. That's almost entirely hotels, which we expect to rebound as we come out of COVID. Asset managers up year on year. Clean energy is up year on year, and I'll go through kind of more details later. Going to page 10. Again, a light quarter. So none of these numbers kind of scream out. This is the rebound for Ichigo, but that is the reality that we think we are experiencing and will deliver to you going forward. But the headline numbers: OP down 14%, net income down 29%, EPS down 27%. That's actually a reflection of our long-term interest rate hedges. So we have fixed our interest rates. We think that's the prudent thing to do. They're very low. And so last year's Q1, we took about 200 million yen of gains, a little bit over 200 million yen, so about $2 million in gains on those hedges. This quarter, we took 170 million of loss on those hedges. These are non-cash, but that's kind of where that big swing is coming from. Page 11 sees the segment details. A real decrease in Ichigo hotel-based asset management fees and performance fees. It's actually relative to pre-COVID more than anything else. Asset management is actually up, as you can see in the middle of the page, on an OP basis, about 6% year on year. Sustainable real estate is down. The stock earnings is again over only from hotels. It's about minus 3 billion yen or $30 million. Full earnings are also down year on year, but you know we sometimes stack our earnings in different quarters depending on kind of what transaction volume looks like. So we don't think that's really material, people. And on clean energy, you can see 25% up year on year. We launched our first wind plant this year, so that in Yonezawa, northern Japan, that is contributory. And we brought a bunch of plants online last year. Thank you. like 9. So we're getting a full year contribution from the solar plants as we enter this year. Page 12 gives you some details on COVID impacts. Hotels high, office low, and retail low is perhaps a little bit surprising for you. So let me go through that. On the office side, it's so clearly the case that there's been a differential impact on mid-sized offices versus large offices, which is to say we only have one large office in Odaiba. And there's been more activity on the part of big companies to move to remote and push back space. In the mid-sized office, which is every single other office asset that we own, we're seeing really no impact. Our tenants are staying. We have had some vacancies generally with companies with direct COVID impacts, so we travel agencies or something like that. And then we release the assets at a higher rate than the existing tenant. So truly there has been very little earnings impact there. And retail is actually similar, which is to say restaurants have been incredibly hard hit. But because we have a combination of some retailers which are obviously more sensitive, and the clearly are retailers that are sensitive to COVID in a negative way, and offset by retailers such as drugstores or supermarkets or kind of slightly more suburban retail locations, which have done very, very well. The over impact in retail is low. Residential has effectively no impact. Clean energy has no impact. Japan has done a very good job of defending incomes during COVID, and so there's really no change in tenants' ability to pay their rent and tenants' desire to pay rents. Again, COVID, if anything, is a positive driver of demand for residential real estate, both as tenants as buyers, because suddenly in your apartment it feels really, really small. So there really is no COVID impact there. In terms of flow earnings, meaning what's happening in the buy-sell market for these assets, there's been a significant impact on office, hotel, and retail. There's been no impact on residential logistics for the reason I just gave for residential. I mean, it's a driver of demand, and also because of higher earnings stability. Logistics, similarly, higher earnings stability and kind of the shift to work from home and the ongoing shift of transactions online, retail activity online, of course, is a driver of demand for logistics assets. Just to speak to office, hotel, and retail, the big issue over the past year has been a blowout in spreads between what buyers want to pay and what sellers want to sell at for office, hotel, and retail. For slightly different reasons. For hotel and retail, just because there have been, immediate negative impacts that are just massive in the hotel space. Worries about retail, both kind of right now with assets that are suffering, but going forward, what's going to happen with online. And office, similarly, what's going to happen going forward from a work from home perspective. And as you probably know, Japanese leases tend to be very, very short, typically 2 years. So in the office market, for example, people are worried that tenants are going to throw back a bunch of space inside office. We already have enough information at this point. So it's been over a year. They've been in COVID. It's almost a year and a half. So 70% of leases have come up for renewal, and they're getting renewed. And so the result of kind of expectation, we're going to break out of this horrible deep COVID period and go into something that we're all going to live with COVID, but a normalized environment and the robust kind of ongoing leasing activity and operating performance office assets has meant we have hotel, retail, and office now market emerging for transactions, and we expect it's quite possible that we'll do some significant transactions, one or more significant transactions in any of those assets, or perhaps all those assets in the second half of this year. Let me turn to page 14 and go quickly through kind of our business model. This is our standard disclosure. You can see we do generate significantly higher both stock and flow earnings than our costs. In the first quarter, we came in at 4 billion yen for stock earnings. Our forecast for both the bottom of the range and the top of the range is 14.4 billion over the full year. So we're coming in about 10% higher on stock earnings. We think there will be, it's very likely we certainly beat the low end of the forecast on flow earnings. and it's quite possibly come in above this the high end of the forecast, depending on what happens in the market and the attractiveness of pricing. That still means we have a ways to go to what pre-COVID looks like, which is fiscal year 2020/2, as you can see on the page. But it's manifestly the case that we're beginning to experience a post-COVID rebound, which is going to take it back to more normalized earnings. Page 15 shows the embedded forward in earnings in the business and the balance sheet. We have significant unrealized gains that exceed our accountings, or our earnings, our economic earnings exceed our accounting earnings, and we have unrealized gains that are earnings back to future periods. Page 16 shows you how, in fact, we have third-party appraisers saying that the assets are worth X. In general, we do somewhere between 2 and 3X of in actual realized earnings. So if the appraisers have told you on the last page that we have about 63 billion, so 600 million US, 100 yen to the dollar, in unrealized gains in the balance sheet, it's probably 2 to 3X that in terms of our actual realizations. Page 17. This is a business that generates significant cash. We run the business in order to do so. We take as much as possible tax shields, such as depreciation, accelerated depreciation. It means our stated earnings, our stated EPS are lower than the actual cash that is generated. That's a good thing for all of us. It means we generate cash that is not subject to the cash, and we can use it to invest in the business and/or buy back our stock when it is cheap. And so that is a hallmark of the business. Page 18 gives some sense of what how we finance the business outside of the equity in it. Japan continues to be, and for us certainly, an amazing place to be a borrower. We're financing all in 90 basis points for debt that is about 10 years. Hasn't been really any significant change. We continue to show the strength and durability of our business and as a counterparty for financial institutions. Page 20 gives you acquisition and sales activity. It was a light quarter. Primarily, we bought a residential that's in the Ichigo Owners business, and we sold 2 logistics assets that we had gone through and kind of done all the value add that we needed to do. I mean, so it's a worthy question as to whether or not we hold those logistics assets or sell them. There's both a strong desire and ongoing robust demand for logistics assets. That's a reason to hold them. It's also the case that demand has kind of gone through the roof as people have as buyers have pushed the real estate spending out of hotel, retail, office into logistics and residential because they feel safer. So we thought we could get, and we did get a very good price. And on that basis, we took the very good price for those logistics assets. And for Ichigo Owners, no sales during the first quarter. I would expect to see a significant transaction, however, during the year. Page 21 gives you some sense of where we've taken the Ichigo Owners business. Again, this is a business we set up from zero on March 1, 2017. So we've now got 4 years of track record. It continues to grow very, very well. This is, we think, a really good business. Very high turnover. Average hold as of end of last year was 9 months. So even during COVID, just robust demand, the ability to execute. I mean, there's some pushing out of, I think the average hold was maybe 7 months, and it's pushed it to 9 months. It's very hard for us to get transactions done during the COVID period. But anyway, as you can see on the page, in the first year, if you add buys and sells, we did 8 billion yen of transactions. In the second year, we did about 25 billion yen. In the third year, we did 37 billion yen. In the fourth year, this last year, we did 56 billion yen. This is a business that's going very fast. We fully expect to get to be about 90 to 100 billion yen pretty quickly. So there's a lot more upside growth in this business. And because we're taking a gross profit, typically somewhere between what we've targeted for about 10%, we're generally delivering something that looks more like 13, 14, 15%. And because we use some debt to structure the business, and because the hold is so short, this has very powerful kind of 30, 40, 50% ROE economics to the business. So the growth is very, very positive. Page 22 shows something new we're doing in the business. So I've just described the existing business, which is on the top of the page. You take whole kind of assets, and this is all Tokyo prime located, brand new residential assets. It makes it very easy for us to hold on the balance sheet, because these are outstanding assets that anybody will want to own. It's substantially de-risked the business, and we generate flow earnings on gains of sale to individual institutional investors, and/or sometimes we'll sell this as part of a private fund business. So we'll get the flow earnings and the gains on sale, and then we'll get ongoing management fees as us serving as a GP to a private fund. The brand new activity, which we started as of May 1, is we've begun a GP, what we call a co-ownership business to our clients, but it's GP LP structure. So as you know, our asset management business currently has our 2 public REITs plus our public infrastructure fund, so the solar power producer. And we also have a private fund business, which is on this page. This structure it's an LP-GP structure using a partnership structure, so it goes under a different kind of regulatory regime, which is a lighter and lower cost regulatory regime. But it does and what it is, it enables to offer small lot investments. So to go after a brand new market, typically on the order of so minimum investment size is about 1 million yen, so about $10,000 US. We're starting at slightly larger than that right now in terms of the first asset we're going to market with, but it does enable you to serve the needs of investors in the real estate category in a brand new and different way. And the market, as we have on the bottom page, is very, very large. We would want, it is our ambition to grow this business to be similar to the size of our existing asset management business. So that would imply several hundred billion yen, so $2 billion plus worth of assets under management. It's something we've just begun, but we think it's an exciting and important new growth opportunity. And our deliverable in this, as is everything we do in Japanese sustainable real estate, is to offer a very high quality product as a fiduciary that is deeply trustworthy. Unfortunately, in real estate, that's not always the case that you have. And this is a business, it's the single largest industry on the planet. There are a lot of actors who are attracted to it, who are not strong fiduciaries, if I can put it that way. And so we as you can see from the growth of our Ichigo Owners business, this is an area where we think we provide a social good, giving investors an opportunity to invest in high quality, durable return of real estate. And that's so important in Japan because interest rates have effectively been at zero for years, for decades. So this is very important for people to be able to save for the future. Turn to page 23. We continue to provide growth support for Ichigo REITs and Ichigo Green. Worth noting on the page is the final bullet point for Ichigo Office. We made a decision to transition to renewable energy across all the assets. We had some partially owned assets that we don't fully have control over, that we aren't able to make the cutover without a more negotiated process. But Ichigo Office is going to be almost entirely renewable energy powered portfolio within the next year. Let me turn to page 24. We'll talk about what's going on in clean energy. We actually changed the graphs, the bar graphs on this page, which used to be speaking to megawattage power generation. We still have that data on the bottom of the page. We also removed Ichigo Green, which is Got, as you can see, 29.4 megawatts on it. But for those who are familiar with our materials, there used to be a green bar running along the bottom that had 29 megawatts on it. So we've just taken that out, and we've shown here purely the activity that's on balance sheet for this company. And it has, and then we show the total capex. And the reason why we made the switch is because megawatts, kind of all megawatts aren't created equally. You do then have a question of kind of utilization rate. And so solar runs at about, you put up a solar plant, it runs kind of during the day. There is a conversion ratio in terms of sufficiency. Utilization of solar is about 15%. We now have a brand new wind plant that is at 50%, so it's 3 times higher. We are planning and expect to do something significant in fully local green biomass, where the utilization is 90%. And so if you show kind of megawatts on the page, they're just dramatically different economics and productivity for this. So we've made the switch to reflect an ongoing diversification of our mix. We continue to expect to do a lot going forward in solar. We have ambitions and are begun work, and hopefully we'll do a lot in local green biomass, and we certainly want to do more in wind also. Page 25 gives you some sense of the wind at our back from kind of Japanese energy policy. It is so clearly the case that the Japanese government is moving towards, so it's currently under review for upward revision, the 2030 target and a 2050 target. Even with the current target, which may be pushed up over 2050, there is just an overwhelming demand for renewable energy. We are not going to solve the problems of climate change by continuing to burn fossil fuels. The Japanese government understands that, and so there's this extraordinary ambition to source more energy in a renewable way without a supply. And so, as one of Japan's major independent solar power producers, we're venturing into wind and green biomass. There is so much more we think we can do. There's so much more that we think we should do on behalf of society, and certainly because economics is a very powerful on behalf of shareholders. So, this continues to be an area with even, arguably a very conservative politically, Japanese administration has made a significant policy commitment to doing more with renewables, which we think will be an ongoing support for activity in this area. Page 26, we provide some details on Propera. So that's our AI-based hotel revenue optimization system. We have been using this in our existing hotels and driving increase in revenues on the order of 20 to 30%. It's a very powerful system. We have begun, and I'll talk about on the next page, new activity in terms of selling this externally. So what we have here is just some sense for you of where we will expect to take Propera over the near term. So our 5-year target is to take it to 2,000 hotels. Which would be 10% market share of Japanese hotels deploying site controllers, which effectively kind of efficient API to allow hotels to link their reservation management systems into online travel agencies. So that's the target, 10% market share of site controllers in Japan over the next 5 years. Page 27 gives you some sense of how we're trying to get there. One of the things we've done is not quite a premium model because we ask for money, even for the light version, but we have been kind of marketing full Propera and realize that there's an opportunity just to go for customer count and build kind of customer understanding of the product and also get more data from it. So we have introduced something we'll call Propera Lite, which gives price trends, visualization only. It does and recommendations to hotel operators. Again, this is a We have an optimization algorithm for hotels. It's incredibly sophisticated. Having told the hotels how they should price their rooms 365 days, 24 hours a day. However, light does not give them the ability to have automated optimization. So, once we tell them what to do in the light version, they have to figure out how they're going to implement that in their reservation system, which is an incredibly manual process. But anyway, it does give an opportunity for hotel operators to get the advice from Prepare and to give them and to begin doing some relatively primitive optimization of the pricing. And for that, we asked for 24,000 yen, so about $200 a month per hotel. And the goal is, again, to take this, including light, to 2,000 hotels within 5 years, and then drive earnings by shifting our customers from light to Prepare over time. And Prepare, the full version of this, we asked for 1% of revenues. So to give you some sense of economics, if you get to a market share of 2,000 hotels, and everyone is sitting on light, that'll be about 600 million yen, so $6 million US, kind of subscription model revenue system. If people are all sitting on the full version, if they're using the full version and using the sample earnings model of a typical hotel on the bottom right of the page, that'll be 4 billion yen, so 40 million US. So that's what we think is a conservative view of where we can get to with Prepare over the next 5 years, somewhere between an ongoing revenue of 6 million and 40 million US. And if we can do more than that, we will certainly do more than that. But we think this is really interesting. And I'm sorry, I didn't talk about the second part of this, which is that we're tightly integrating with the site controllers to allow users to get onto our system easily. We will have access to 16,000 hotels, 80% of all Japanese hotels. We're effectively at that right now, and we think we will keep that this year. Page 28. As I mentioned earlier, we're excelling our RE100 target by 15 years from 24 to 25. So RE100 is just a commitment to have 100% renewable electricity across all of your operations. So we do that by 2025. Page 29 shows where we're today. And so here I probably need to explain to you that the RE100 does not kind of envision self-production of renewable energy. And so, the truth of the matter is we're already net zero carbon today. And so we more than get to the RE100 target. We don't need to wait another 4 years. We are there today. Our total power plant production, CO2 reductions, is about double our CO2 emissions. We are net zero carbon. We are a positive contributor in the global fight against climate change today. And so what that means is that the target of going to RE100, so because we are by the RE100 initiative, the way it counts things, if we're selling our renewable energy to our customers, they don't count it as part of our renewable energy contribution. So what we're effectively telling you is we're going to do both. We are going to continue to grow our own renewable energy production. We're likely to sell all of it externally, but we're also going to buy in because we run the math on it, and it's certainly very doable to buy in renewable energy, despite what I said earlier, a gap that is going to grow significantly over time. Currently, there's barely any premium to renewable energy, so we can make this shift with contracts that we think are good for the world and good for our tenants who believe in working for the world. Page 30 shows our buyback activity. We've done buybacks 5 years in a row. We did one earlier this year for 1.5 billion yen, so it's half of what we've done in previous years. We would expect to have ongoing buyback activity given the cash generation and we think is a low share price. And finally, page 31. Just a reminder that we are a J-League sponsor, so Japan's soccer league or football league, to use the global word for this sport. And this is something that has kind of had curtailed activity, given that we've been operating under COVID. But we do have a shareholder program where we give tickets to our shareholders to go to every JV club and every JV game, and that's something that we will continue to do going forward. So that is the prepared presentation. We're going to now begin the question and answer session. So if you are online in Zoom, you ask a question by raising your hand. And maybe you're more sophisticated on this than we are. This is the very first time we've done this. So apologies if we have any challenges in getting this done with you. And when it's your turn, you can unmute yourself via prompt, and you can and then you can press and you can go for it. If you are on the phone, you press star then 9. If you want to withdraw your question, you press star then 9 again. When it's your turn to speak, you press star then 6. So hopefully we're all going to get through this together. But anyway, let's and you can also ask questions via chat. So 3 ways to get into the call. You either go through the Zoom app or browser, and you raise your hand, and we get going that way. You can do it via the phone, or you can do it via chat if you're online. So why don't I take the first question or input of any sort from anybody? The line is open, as it were. The app browser, the browser, the line, and the chat session are all available to you. Again, thank you for your time today. So the first person we have.
Hi,
Go ahead.
Yeah, this is Greg at Point72. Can you hear me?
Hey, Greg. Thanks for joining. Of course.
Yeah, thanks very much. My first question is on the asset sale.
Yeah.
As you mentioned, Scott, the office business has been pretty much unscathed by COVID, and obviously everybody has noticed that your REIT is now back above NAV. I guess obviously you cannot comment on asset sales, but my question is more, it seems to be easier to sell office, but you haven't sold anything in Q1. Would you still be looking to sell potentially in the rest of the year, or do you have like a balance issue in your portfolio where you prefer to keep office and sell other assets so that you don't deplete, and sell what you can sell as opposed to what you would like to sell? Would be my first question.
So both statements are correct, Greg. Yes, we expect to sell offices this year, and so we run hopefully what you would our shareholders and investors would think is a pretty robust and rigorous process. So we have a sale process which invites everybody in order to make sure we can get the best price. And so that takes a little bit of time. So we think there will be activity in the second half of the year. And secondly, we do pay attention to kind of the mix of our portfolio. It's very diversified. At this point, it's about a quarter retail, a quarter office, a quarter hotel, and about a fifth residential. So we're not going to sell office all down to nothing, unless, of course, there's an amazing price. Everything on the balance sheet is for sale. But the reality is we expect to do transactions across all of those asset classes. We expect to do residential sales, office sales, hotel sales, retail sales. The market is reopening. It is manifestly the case. Now, things could happen between now and kind of the timing that we're looking towards. With the degree of kind of normalization that has occurred, there is an ability to transact at levels that we think make sense. And that was not the case for the last year.
Understood. And hotels, have you seen a narrowing of the spread between buyers' price and sellers' price? Is that kind of coming down a bit?
Yes, and that's because it's a really interesting question as to how Delta and the other variants could affect things. But the vaccination progress has been robust enough. It appears to be the case that potential hotel buyers are taking the view that even if we have particularly difficult variants, COVID variants out there, that there's going to be a vaccine solution And so the desire for like really big discounts, that we didn't think necessarily reflected normalized earning power for hotels has gone away. So there's been a closing of spreads in the hotel space also.
Understood. Thank you. And one more question, if I may, is regarding Propera.
Yeah.
You've given us 5-year targets, which is very useful.
Yeah.
When I look at the market share, obviously outsider looking in, I have the impression that it's an ambitious market share, but at the same token, you usually express targets so that you can beat them. So
Yeah.
I'm intrigued, what did this 10% represent, and do you already have fairly good leads that would make the business kind of take off on year one, so to speak? Thank you.
Yeah. So actually, the targets on page 26, so the previous page. Yeah, that's a thank you. That's a worthy question. We do tend to be conservative, and we put out targets that we can beat. And in this case, the reality is that ourselves internally and our existing, so give you some sense of this. We have 46 external customers right now, so about 50, right? So we're going to take that, we think we're going to take that up 44. And effectively that's an exponential growth curve. We get that. The revenue results are so powerful for our customers, for ourselves internally and our customers, that this is very straightforward. The return on investment, the uplift in returns for those people using Propera is so powerful that we think there is a major market opportunity. And 10% to that extent, it will be interesting. It's an interesting issue because we're either going to succeed or we're not. And if we succeed, we're probably going to be well more than 2,000 hotels. But the issue and the reason why we introduced Propera Lights, that's on page 27, is we're introducing basically very sophisticated technology, cutting edge technology in a business. So kind of could you put it on page 27? That in an industry that the Japanese hospitality industry is unlike the restaurant industry, and I've said this before, where the Japanese restaurants are absolute world class. The hospitality industry isn't necessarily cutting edge, and so you have a serious degree of conservatism. And so just getting people to try, we show people all the data, our data. And with a multi-year track record, it's proved to be like a very tough sale process. So it's like, okay, fine, let's just make it a lot cheaper for people to participate and prepare and see the results. So yeah, we think these targets are credible. The big issue, as I said earlier, is there's going to be different economics to Propera Light and Propera the full version, and so. And it's effectively 6.7-fold difference. So migrating to the full version of Propera is, of course, going to be an important element of this. But yeah, we think this is doable, and we think we've probably been insufficiently transparent about what our ambition has been, and you'll see we're likely to offer some more disclosure on what we think we can do, for example, in the owner's business too. Ichigo is in a little bit of a place where we kind of we don't talk about what our goals are, and we kind of say, and so now we've achieved this, and so it's kind of hard to value the future if we don't give people guidance on where we think we're going to take the firm. So you can continue to count on us to be conservative, but yes, we do think there is a big opportunity here, and we fully
understood. Thank you very much.
So we have someone else, Richard. You can go ahead.
Hi, Scott. Thanks for this. I just one question on the business on slide 15, where you show that last year the appraisal based or the of the value based unrealized gains grew by more than 10%, basically accelerating from the growth in the previous years.
Yeah.
So yeah, and given basically the impact on office and retail space and hotels, so how did you achieve this, and could you put some extra color on this?
Yeah, I mean, just to be very, very clear, these are third-party appraisals, so this is not Ichigo.
Mhm.
What these things are.
Mhm.
You know, look, there was there continued to be robust kind of NOI coming out of the assets. We did do a markdown, and there was a little bit of that we had kind of taken out of these appraisal on our own. That so we actually haircut the third party appraisers. Said our assets were worth in FY22, and the appraisers kind of went back and looked at it, and we went back and looked at it, given the post-COVID. I mean, kind of, we're still all on COVID, but given the pending rebound, we removed that. So that was kind of, I can't remember, order of magnitude was about half of this here. But the reality is the assets continue outside hotels, which are clearly in a very different space, continue to perform very well, and the third-party appraisers have recognized that.
Okay, and maybe another question on office. So you mentioned that the impact of this pandemic on large-size offices is different from the mid-size. Are you seeing now some more concrete? Yeah, could you specify this a little bit more? And do you see that companies are really changing the model they operate and with satellite offices? Is it yeah? Do you see the demand coming through and or other yeah, confirmation of this?
So we've had some uptick in vacancy in our mid-sized offices, but it's almost entirely been kind of COVID related. And I think I've talked about this before, but roughly, you know, the kind of offices we have is central city location. Typically, the first floor is going to be retail, because you can get kind of twice the rent for the first floor retail relative to the kind of the floors 2 through 10 through 2 through 20 or whatever. And so, you know, we have had some vacancies in the first floor retail tenants. We've also had a little bit of vacancy from necessarily like travel agencies and things like that. It just so clearly had a COVID impact. And so when we get the vacancy and we lease up, the first floor retailer, we've been able to find, as I said earlier about retailers, we've been able to find replacements like drugstores and, you know, other retailers are doing really, really well. And so that's not been a problem. And the office tenants, we've been able to find office tenants. And so the net effect of a COVID-linked vacancy has been an increase in NOI, that we're releasing the spaces at higher rents than the previous tenants. It is just remarkable story about the robustness of these smaller mid-size assets that serve overwhelmingly small and mid-size companies. And to be clear, you know, sometimes people worry about SMEs and the credit kind of capability, but in Japan, this is incredibly. I mean, of course, we do credit screening, but incredibly robust tenants that pay their rents. No big move to remote on the part of SMEs in Japan. And so that's just been very durable. Now, the one exception to this is the one big asset we have, which is Odaiba, where we were going into COVID, we were going to re-tenant the place. And so we actually expected to have 30% vacancy. So it was going to go down 70. And then COVID occurred, and we got an additional 25% of notices from big firms and or IT firms that are, I mean, they actually proved to be big IT firms that decided to go more remote. And so Odaiba has gone down to 45% occupancy at this point. And what's happening with there, and so that's like a completely different outcome than's happening with our small and mid-sized offices. Again, this is a former headquarters building of a major Japanese corporation. It's a big asset, big companies are in it. And yet, even in the case of Odaiba, we're releasing it at rents that are kind of at or above our business plan. So we'll take a year to do that. And it's going to cost us probably $3 to $4 million of rent this year. But that is so noticeably a very different outcome than it's with our small mid-size assets, which are kind of the bulk of what we do. So yeah, I mean, things are fine. Not only fine, again, we continue to be long vacancy. If we get vacancies, even in COVID, we get an upside from it. And it has always been our belief, and this is why we involved in small and mid-sized offices, that it's an underpriced, incredibly powerful, durable asset that, you know, people seem to like big buildings and they don't seem to understand that big buildings tend to have more powerful tenants, more aggressive, turns out, to go to work from home in the COVID environment as perhaps a one-off. But you know, you're better off with the durability of earnings. Small mid office.
Okay, and then maybe a final question. You mentioned earlier that this quarter and the next quarter will probably are a bit light, but that there are some big changes, underlying changes happening, of which the results will be seen from the second half year onwards. What do you mean by that? And could you add a bit more light on these big changes that are happening? Or did I misunderstand it?
Well, thank you. I probably just explained it poorly. Sorry, Richard. Thanks for asking the question to give me a chance to clarify. So by light, I mean, you know, this is not exactly a quarter where you go, wow, what a great quarter. You know, but you know, typical for us. I mean, as I said earlier, our accounting earnings, you know, are below our economic earnings, and in this case, it's a little bit more. You know, we've got a bunch of things in the pipeline that we're highly confident we're going to deliver on. So you're just seeing some moving around within the year where earnings show up. But the second element as to why and what has changed is, you know, we think we will see some coming back of stock earnings, kind of hotels likely towards the end of the year as Japan vaccination rates continue. We don't really need tons of global travel for that to happen. Japan just needs to go back to a more normalized environment. We think that probably happens. But most importantly, it's the flow earnings. So if you look at page 14, which shows, you know, 7.7 billion in flow earnings in the bottom of the range and 12.1 at the top of the range. You know, we'll see what happens. We feel very comfortable that we're going to be within that range and possibly go through the top. Because of a turnaround in the ability to sell what we think are very good assets in a market that's less frozen.
Okay, thanks.
Thank you. I think we have someone else. I'm getting a note. Oh no, it's a question via chat from Will. I'm going to read it. I'm going to read it out loud. Last time you mentioned the office asset in Odaiba had 2 large IT tenants vacant. Any comment on releasing activity? Yeah, I mean, we're releasing. We think we'll kind of fill it back up within the next year. And just as a reminder, so this is an asset which was smack right in the middle of the Olympic venue. So, you know, and so it's just really, really tragic. You know, we were going to get, people get all excited about the Olympics, which is, you know, including the Paralympics, is only a 2-month event. So we never quite understood how people would get really excited about, wow, you know, this is going to be fabulous for real estate. It's like, this is just a 2-month event. You know, you can lease your hotels for 2 months for, you know, 3 to 5 times the normal rate, but it's only 2 months. You know, the additional hope was that we're going to get all this activity in the area and people were going to be excited. It was going to kind of build more value and status and prestige for the area. And that kind of, unfortunately, is not going to happen. Now, having said that, Odaiba is located kind of 15 to 20 minutes from city center, depending on how you, Japan has multiple city centers, but from kind of the western and eastern cities, you know, parts of the city center. And this is a very high quality asset with, you know, super high grade specs that we're leasing for kind of 17,000 yen per tsubo. To give you some sense of that, that's probably half to a third of what you get in kind of more city center for equivalent kind of asset. So it's very good value is one thing that is just super powerful. So the vacancies that have gone up, to be clear, the reason why big buildings have been impacted, you see three things. You see very expensive space being sent back. You see space being held by big companies being sent back. You're seeing space held by IT companies being sent back. In the case of Odaiba, we've had the second and the third, but not the first. I mean, it's just really good value. One. And two, the thing that's interesting is you see kind of more work from home and, you know, businesses are kind of slightly more desirable of having low cost space, of course. And there's been a little bit of migration of work activity in general towards home, but it means, and this is out closer to Chiba, where Disneyland and where the airport is. It actually has kind of been a little bit of, for reasons that aren't clear to me of, if we're not, you know, we don't need city center space nearly as much. And so again, to be clear, this is 15 to 20 minutes from city center, but we're very much, you know, massively within commute distance and all that sort of thing. It's kind of a secondary office market that we thought was going to grow more. Doesn't necessarily look it's going to grow more, but we'll find out together. Anyway, ability to lease it is robust, and we're just leasing it up. So you should expect to see us back to where we were about a year from now. Happy to take more questions via chat or app or browser or the phone.
Will has another question.
Okay, Will has another question.
You mentioned office logistics and residential asset sales. Now, how about renewable asset sales potential?
Thank you. So Ari is now reading your questions. This is better than me. Yeah, well, we've gone through this before. I mean, everything in, you know, to be clear, we don't have this thing where it's like, we're never going to sell an asset. It'll work for you. If an asset is sellable at a price that we think is a really good price, we'll sell it. You know, having said that, you know, there's nothing right now where, and it's an interesting question as to why. And we probably should do some more work on this. But you know, at this point, there's nothing that is like this asset is priced below where it should be. If anything, our view is, as I said earlier, that there's kind of massive, particularly because of changes in Japanese energy policy. But you know, those reflect kind of overall demand for renewable energy. So you know, private companies, for example, are feeling pressure. So Japan has a huge manufacturing base. It sells to the world. It sells to companies that increasingly want to source via renewable power, renewable energy. So they're asking their suppliers to use renewable energy. So when you run the math, we can't figure out where the supply comes from to meet this demand, which is a way of saying that we think it's quite possible. As I said earlier, there's not a particular premium for renewable energy right now. It depends on the region, but across Japan, on average, there's only a small premium for renewable power. We think it's possible that that premium can go very substantially, because if it doesn't go up, it's impossible to meet Japan's national energy goals. It's a way of saying we could get a significant push again on some version of FIT for subsidizing renewable energy via the government. Right now, as you know, the infrastructure funds only have a 20-year non-tax period. We could get that generated, make them truly readable. So REITs have a permanent non-taxable period. The Japanese infrastructure market only gave 20 years. So again, that would be a reason for the infrastructure funds to be able to purchase at higher prices. And we think that that is very possibly a subject of Japanese government positive policy change. So anyway, I mean, at the moment, we see kind of no rush to monetize our energy assets. Now, it's probably worth pointing out that on page 15, those are only our unrealized gains on real estate. It doesn't show our unrealized gains on our renewable energy portfolio, which we think are very substantial. And I probably have to duck and cover on what the number is. Kind of certainly 30 billion yen, possibly 30 billion yen. I mean, not small numbers is what we think those numbers will apply. So there is a lot of value there. And if and when we choose to monetize them through an asset sale, that will be a powerful driver for us. We're happy to take more questions.
Hi,
Hi, who is it?
this is Garrett from Truffle Hound Capital. How are you?
Thanks for calling in.
Absolutely, thank you. So just another question on the green energy business. In
Yeah.
the past, we've talked about cap rates on these development assets of 8, 9, 10, 11%.
Yeah.
And can you help put that into context? Because in the value add real estate business, the cap rates discussed are more like 4 to 5%. And so why is it the case that the cap rates in the green energy business, which, as you mentioned, has these tailwinds and has, guaranteed pricing for 20 years through the FIT, why are those cap rates so much higher?
Part of the answer is that that's a pre-depreciation cap rate. And so if people think that, we actually think there's a market mispricing. If people think that your asset is only good during the FIT period. And so in other words, depreciation is roughly about half, right? So if you think that there's no terminal value to your solar plant after 20 years, then it means your renewable energy assets are also generating about a 5% cap rate. Now, we think that is manifestly wrong, but it's interesting because there's a difference in pricing between global solar assets, which do see value beyond FIT periods, and Japan, which seems to put no value at all. And we've run the numbers on this. And what happens after 20 years is you do need to do, there's a very small degree, and you probably know this, of depreciation over time, like kind of less than 1% a year of the ability of solar panels to produce. You do need to do some changes in what they call, and forgive me, they're called power conditioners in Japanese. I can't remember what they call in English, but the equipment, it's not just solar panels. You need to take those panels and convert them to electricity. You need to do some conversion there. We've run the numbers on that, and we fully expect to be a sub 10 yen per kind of kilowatt power producer, which would make us, and well below 10 once the FIT period ends, which would mean that these are going to be very profitable energy assets. And again, if there's a premium for renewable energy, then it would be even bigger than that. So yeah, I mean, our view is there's actually a mispricing. Full stop.
Okay, yeah, because it certainly seems out of line compared to how these kinds of assets are viewed in the United States.
That's exactly right. Sorry.
Okay, and then another question on Propera, longer term, if it's successful, what can you kind of talk about the cost structure a little bit? And one specific question is there any kind of revenue share with Fujitsu?
No. So those are our economics. Yeah, I mean, it's got the kind of the classic platform kind of exponential economics to it. We put a couple $1 million into developing the system. We've continued to upgrade it, but the ongoing kind of the ongoing kind of IT requirements are de minimis unless we want to bring in kind of new functionality that we think we can monetize. It's a very small team, and so we're going to have to put people into a certain amount of client service, but it's a very straightforward system, and it's an automated system. So the client service is a little bit kind of And it's fully automated. So it's just like, here's how you set it up. Congratulations, you're about to make more money from your hotel. So yeah, I mean, the numbers that I said between 600 million yen and 4 billion yen, so call it, again, $100 $6 million to 40 million a year. Almost all of that just drops to the bottom line is OP. So like the business a lot. And of course, we want to do more with it. And more would be not only taking more market share, but expanding capabilities. And I've talked about this in previous calls. I mean, so currently we're focused on hotels, but this is a dynamic pricing algorithm. So your ability, you can take it to, other assets. You can take it to karaoke, you can take it to stadiums, you can take it to museums, concert halls. I mean, clearly already, you can take it to retail. I mean, clearly already the airlines have figured this out, and sophisticated hotel operators, have figured this out. But this is, a very low cost, very high quality product. With machine learning and a huge database, we think we have, and this gets to Greg's, question earlier. Why do we think we can do this and get this kind of shares? Because we think we have the best product in the market, and having more data to feed the AM and the machine learning, we think increasingly give us the ability to deliver more economics to our hotel customers.
Okay, great. Yeah, I think the strategy of getting as many customers as possible rather than prioritizing like near-term cash flows makes a tremendous amount of sense. So thank you and best of luck.
Yeah, exactly. Yeah, it's interesting. I mean, it took us a while to get there. I mean, we're classically huge cash on cash return, real estate, and then we did energy, again, clean energy, and so it took us a while. My apologies to kind of get to. Wait a minute, we should just kind of go for growth. We should get this thing out there. A little bit internally to take you inside the curtain of like what people. The whole point of this thing is for it to be fully automated and for people to make tons of money. Why do we want to do? Why would you want to break the system and give them, something that doesn't do this for them? But the answer was, in order to give tenants an ability to test in a way that kind of asks less economics from them upfront. So yeah, we're excited. We think this is the right way to go. And sorry, as usual, I wish I could figure this stuff out quicker. Sorry it took us a while to get there, but we think this is a big opportunity. Anything else? We'll open again for questions and or input.
Yeah, hi, this is Greg again. Can you hear me?
Yeah, thank you.
Yeah, just a quick follow-up, and actually a contrary question to Will's question. I was going to ask if you would accelerate the investment in renewable and whether you would also consider investing from your funds, especially in the secondary market, and any thoughts on the trajectory there? Thank you.
Yeah, I mean, we do have ambitions to do more, and there will be three potential drivers of our renewable energy business. One is clearly solar. It's the most competitive. And people talk about, for example, wind, kind of offshore wind. It's just so expensive. I mean, it has an advantage of being able to do size, but it's literally, our calculations are about 7 times more expensive than solar. So solar is a super competitive asset. To the extent we can get advances of battery technology, that will help it become a base energy asset also. But solar is an area we have significant capability in doing more work on. The second one, as I said, is local and green biomass, which has limits in terms of the size. We're doing kind of local forest, and we're going to prevent the forest from dying, which is why this is truly green, as opposed to kind of doing chips in the southeast United States and sending them across the world, which we do not think traditional biomass is actually green. And the third one is, so solar is a really obvious one. Green biomass, we've done a lot of work on or making progress on. We hope to be able to introduce that in the beginning of the next kind of 12 to 24 months to our portfolio. The third one that's a little bit of a variable is onshore wind, where we have more coming. We'd like to do a lot more, as I said, because of the utilization rate is higher than in solar, and its ability to deliver kind of a lot more kind of some mass that is not necessarily the case with with solar, given the limited amount of land that's available for continued solar activity here. And there, it depends quite a bit on government policy and what they're going to do on the grid, because the problem we have with wind right now is the grid is not kind of strong enough and not smart enough necessarily to accommodate it. So we do need some help over the next 5 to 10 years on that for us to be able to do a lot more in wind. But if possible, wind is far more competitive. Onshore wind is far more competitive than offshore wind. So, probably more expensive than solar, but you're going to run out of solar opportunities. So, something maybe that's more like a 2x, 2.5x to solar as opposed to offshore, which is 7. So those are the 3 drivers, and if possible, we do have a pipeline for onshore wind. We will do more there. We expect we will do more in solar. We expect we'll do more in biomass. So the key question is, how much more can we do? And we're going to try to do absolutely as much as we can.
Would you consider a solar rooftop, or are you doing just normal plants?
Yeah, the problem with rooftop is you do need a sales channel for it. And yeah, I mean, we're trying to be thoughtful about everything, and that includes rooftop. But it is a different business model. You do need to have the ability to service, do small scale, get it up there. And potential service depending on the business model. But yes, that is something we're all about and we'll think about.
Understood. Thank you.
Thank you. Currently, there is no one in the queue, and we've gone over an hour. Sorry about that. I guess we should probably take someone just popped up. Are we done? So unless there's anything else, I think we're going to bring this to a close. Thank you, everybody. We really appreciate your time. I appreciate the opportunity to work for you. I know it's a very hard time in the world, so everyone take care and be safe. Have a good day.